Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We are seeing futures now pointed up across the board, even after China came out, rebuffed Trump's statement that they were in talks and said the U.S. needs to lower tariffs completely before they will get into discussions. So we have 0.2% now on the S&P, almost double that on the NASDAQ. Investors more bullish going into this session than they were over the past couple of hours. Down at the New York Stock Exchange, we've got Volunteers of America ringing the opening bell. Good for them. And down on the NASDAQ market site, here we have Pinnacle Foods ringing the opening bell. PFAI, the ticker there. But Katie,
yes,
the word that they may be thinking about, that they may be concerned about, is uncertainty. We've been hearing that across the board out of earnings.
It is the word of the season, truly. If I had a dime for how many times uncertainty had been said on earnings call, I would have at least 3, because you had Chipotle and PepsiCo pulling their outlooks this morning. American Air also pulling its 2025 guidance entirely. I'm getting closer and closer to $1. You take a look at what's happening to these stocks in the pre-market. You actually have, or rather the open, you can see that Chipotle higher a little bit, PepsiCo down a little bit, American Air a little bit higher. Just feels like everyone's tired, Matt.
Yeah, I will say Southwest called out uncertainty. Alaska Air called out uncertainty. America Air called out uncertainty. Pepsi uncertainty. CMG, Chipotle uncertainty. IBM, Texas Instruments, Masco, Sonic. I could go on and on and on. And across the board, executives have no idea what's going to happen. And that's not great for business. That's not great for earnings. Bloomberg's Alex Semenova has been following the S&P 500 earnings broadly for us. So how are things looking, Alex?
So the results themselves for this quarter are pretty solid. If you look at the numbers, 78% of firms surprised to the upside. That is the most since the second quarter of 2024. Year-over-year earnings growth is at 7.4%. It's slightly above preseason estimates, but slightly lower than the past 5 quarters. But as you mentioned, Matt, it's not about what was in the past. It's about the future. And a lot of companies just don't know how to quantify the impact of tariffs on their businesses at this point. And that is really spooking investors. Earnings revision breath, which is a measure of upgrades versus downgrades, is approaching downside extremes. Morgan Stanley said that it's at levels that they've never seen this before. And the language from companies, as you said, guys, across various industries, Alaska Air, Pepsi, Chipotle, IBM, volatility, uncertainty, just that's the name of the game right now.
Yeah, we've been talking about that earnings revisions breath figures for a while now, because it is pretty stunning to see them at recession levels. And it just feels like, and this is a point we've been making, that every data that isn't real time, every data point feels stale at this point. So when you take a look at the sell side strategist community that you cover so closely, we're talking about Deutsche Bank downgrading their expectations for the year end just this morning. I mean, how do investors and strategists plan around all of this uncertainty?
I mean, the reality is no one knows what's going to happen, and a lot of strategists just don't want to admit it. If you look at Bank of America, Civitas, the Romanian, there said that the S&P could end anywhere from 4,000 to 7,000 by the end of the year, just highlighting the range of outcomes. JP Morgan said the same thing. They said it's basically impossible to, figure out what direction stocks are going, and you could look at the fundamentals, but anything can be changed by a tweet at this point.
All right, Alex, thanks very much. Alex Semenova there from Bloomberg News talking to us about the earnings reports thus far. We're only about a third of the way into earnings season, so there's still a lot to go, and the big ones are yet to come, the scary ones, like the big Mag 7 and the retail names. We're back with Manulife, John Hancock, co-chief investment strategist, Emily Rowland. So, Emily, I mean, especially for automakers, right? Their tariffs are changing on a daily basis for makers of electronics, chips, smartphones. What are the executives to do? How do you handle this if you can't put CapEx, if you can't make hiring decisions, if you can't know how much your goods are going to cost on ships?
Yeah, it's a massive challenge, Matt, right now. And that's the reason that we're seeing companies pulling guidance. They just don't know. We're seeing companies announce 2 different sets of guidance based on how punitive tariffs are going to be to their business. So again, a lot of uncertainty, but what we have to watch is what's actually happening. And even though the sentiment surveys are just incredibly bearish right now, we have to look at the real-time data. That's the best we can do right now. And things like initial claims this morning coming in at 222,000. 50,000. Continuing claims actually coming down a bit this morning, and high yield bond spreads, which has peaked at about 450 basis points, down under 400 basis points. So we are watching the hard data right now. It's telling us that the economy is slowly slowing, but still doing fine. And in that case, companies should be able to maintain their margins. They should be able to continue to, provide solid footing here for the labor market. And until we see those real-time measures of economic growth start to move lower, then we see us in a solid position.
Well, I'm curious to take this conversation cross-asset. You bring up high-yield bond spreads, for example. Are there any asset classes that you can pick right now and say, this is insulated? This maybe not quite tariff-proof, but this is where I want to be. I'm thinking about gold, for example, hitting 3,500. It feels like that is one of the only true havens in this market.
Yeah, I mean, gold has just been on an absolute tear to, which obviously isn't surprising. It tends to be a hedge against both inflation and geopolitical risk, but certainly it's run a lot here. And we want to look to where there's relative value. So I think what's really notable about this market is that the assets that have sold off the most are actually the highest quality ones. You look at tech, and of course we had a valuation issue coming into the year in U.S. mega cap tech, but tech is the poster child for quality. These are companies with great balance sheets, better earnings growth prospects, wider moats. And you've seen really the baby being thrown out with the bathwater to a large extent. And meanwhile, the relative winners have been things like European financials and German industrial companies. Those parts of the market are highly cyclical and tend to trade on a rebound in global economic growth. We don't think we're there right now. We think the global economy is slowing. If U.S. exceptionalism is at risk, global exceptionalism is at risk here. So we want to look to those higher quality assets that are on sale.
Well, you could make the case that a high quality asset on sale right now is placed at the long end of the Treasury curve. You had PIMCO, JP Morgan Asset Management coming out and saying that there's actually opportunities there after the sell-off we've seen. But we know that bonds have been a really unreliable hedge, Emily. Where do they fit into a portfolio right now if you're looking for safety?
Yeah, Katie, coming into the quarter, we actually increased our allocation to high quality bonds. We would look at any backup in rates as a gift to investors right now. And one of the narratives that I think investors might not be fully sniffing out is that we see disinflationary trends taking hold. I know that there may be a short-term inflationary impact of tariffs, but we look at things like the housing market, which drives inflation. And if you look at shelter CPI, that finally came down last month. 0.2%. Real-time measures of housing are suggesting more disinflation there. Mortgage rates are very prohibitive. They're back above 7% right now. You look at things like supply coming online. We're seeing some of the biggest jumps in housing supply that we've seen in quite some time. At the same time, that demand is stagnating due to unaffordability issues, higher insurance costs, et cetera. So if we can start to see housing continue to come down here, that brings inflation down and provides a counteracting force to the inflationary impact of tariffs here. So watch that dynamic playing out. That means bond yields move lower, and there's a lot of opportunity for total return potential within high quality bonds.
I wanted to bring up the inflation subject again as well. As I mentioned in the last block, Donald Trump put out a truth this morning. He says gas and grocery prices are way down, just like I said they would be. Eggs are plentiful and down 87%. Nice. If you look at the data, and I realize that some of this data is not fresh. For example, the white line here is the CPI food index, up. Okay, that ends in the end of March. We could see a drop there. The blue line is average national gasoline prices. Those are updated, if not daily, weekly, so that's not too backwards. It hasn't really come down that much thus far, Emily. So should the Fed be looking at a preemptive cut, or should they still be worried about inflation?
Yeah, the Fed's not going to act preemptively on the inflation front. They're going to be looking for confirmation in the real time data, which may lead them to be behind the curve here. But I do want to comment on the commodity discussion there, because if you do expect a meaningful rise in inflation from here, that almost has to be accompanied by higher commodity prices. That is really a key driver. And we're seeing the opposite based on particularly demand out of China slowing on decelerating global growth there. So if commodity prices can come down, if we can see housing inflation come down, that is something that's going to be a positive here for the bond market. Yes, rates are chopping around here, but I don't think that bonds are sniffing out the slower growth and disinflationary environment that we think unfolds over the course of 2025. Got to be maybe a little bit patient to get there.
Yeah, there's a really interesting disconnect brewing between, of course, survey expectations of inflations and what we're actually seeing in commodities. Unfortunately, we got to leave it there. Emily, great to speak with you as always. That is Manulife, John Hancock's Emily Rowland. Now, coming up, ServiceNow results show strong demand for software. We'll hear from CEO Bill McDermott next. This is Open Interest. Welcome back to Open Interest. A check on stocks at session high with the S&P 500 higher by 0.4%. You can see that a lot of that strength is coming from big tech, with the Nasdaq 100 up about 0.8%. The little guys getting in on the action too, but we'll see how this picture changes as we get deeper into earnings season. Alphabet after the bell tonight, but it's time now for our top calls. Some of the analyst action in focus this morning, and first up, Oreo maker Mondelez getting a downgrade from D.A. Davidson on soft snacking demand and cocoa volatility. Next up, you have Deutsche Bank upgrading Huntington Bank shares and M&T Bank. The firm is confident that bank stocks have bottomed and also sees upside in the large regionals versus the big banks. And finally, ServiceNow getting raised to a buy over at Present Capital Management. The software company reported first quarter results that beat expectations and gave a strong outlook. And Matt, shares currently up almost 14%.
Yeah, absolutely taking off. And we are going to talk with Bill McDermott, the CEO of ServiceNow, formerly of SAP, in just a moment. Those shares going the opposite direction of what we see happening with IBM. IBM is down after it missed expectations for sales. They did grow, but only 1%. Bloomberg Technology's Caroline Hyde joins us now in the studio to talk about the company out of Armonk. So IBM missing expectations. What's the problem with Big Blue?
They didn't actually miss expectations, Matt. They actually beat. If you look at sales, we were expecting flatline in sales of 0%, but they managed to eke out 1% growth. But I think where you're right is the fact that there were built-up expectations because the shares have risen so hard. These sorts of companies, software-exposed companies, have been outperformers in the tariff turbulence, ultimately, because they have little exposure more broadly. Yes, they get mainframes. Yes, of course, they build plenty of their own hardware when they're thinking about quantum, but they build it in the United States. Ultimately, you're seeing software still remaining resilient. Many questioned whether DOGE, whether the efficiency coming from the government would be something that impacted shares. But ultimately, it seems as though that's not coming out in this set of quarter for IBM nor for ServiceNow. But there is a sell-off in IBM because I think the shares have rallied so hard before it.
Yeah, down, I think, 8% in the pre-market last time I checked. So big drop there. That looks nothing like what we see at ServiceNow, where Katie just showed us the shares up 14%. I think Bill McDermott is good. Let's check in with him.
Let's check in with him, Matt, because I'm pleased to welcome to the show the ServiceNow CEO, Bill McDermott, who joins us on the back of what is some stellar numbers. Your shares are rallying. We're seeing basically a beat on sales. We're up 19%. You're also, though, delivering strong guidance when many other companies are pulling their guidance, Bill. What gives you the confidence?
We have an amazing culture here, Caroline. Elite level execution defines ServiceNow, and our AI acceleration delivered another outstanding quarter. It actually quadrupled. So ServiceNow has really become the AI operating system for the enterprise, and we see the software industrial complex literally integrating onto ServiceNow as the standard from every corner of the office. Companies are looking to run efficiently, effectively, with a different margin profile for this economic time, and we were built for this moment.
You do talk about potential risks regarding geopolitical environment. What are those risks? How are you seeing them?
Well, I think if you look at it, why we're so well positioned for this moment is companies today, let's take the auto industry as an example. Tariffs are on the table and that industry is affected. So these companies have to think about the marketplace very, very differently. They have to reorient their supply chains in real time. And only AI can do that. And you say, well, why did I have to do that? There's 30,000 parts that go into manufacturing a single vehicle. They may not be able to pass on the $10,000 increase to the consumer. So companies like ServiceNow can get them to tier 2 and 3 suppliers, sign up new suppliers in real time, and position these companies to win. And this is true in every industry. It could be insurance, it could be pharma, it could be retail, manufacturing. It's all in the focus of ServiceNow to help these companies innovate.
Let's go from private companies to the public sector. And I know that you've won a federal contract, but many had a lot of anxiety about what DOGE meant for you. You said DOGE loves you, but why would DOGE love you at this moment?
Well, we're laser focused on modernizing government and elevating how it serves the American people in the U.S. And what's really interesting about DOGE, it has formed a standard that other governments around the world are following. So our public sector business was up 30% year on year. We had 6 new public sector logos, including 1 large U.S. federal agency. We have 11 federal deals greater than $1 million, and 2 of them were greater than $5 million. And this is net new software sales. So this is kind of a big moment because we are the only software platform I'm personally aware of that can take out billions in cost in government around the world. And certainly the United States is looking at that very closely, and we're excited.
I mean, have you spoken to Elon about the work that he's doing? How did you make sure that you were protected in this moment to be able to bring the transformation, bring the efficiency?
Well, you have to remember the agencies are run by amazing public servants and great leaders. And DOGE is doing the right thing. They obviously want to make good for the American people so the taxpayers get their benefits. Our platform is front and center in helping them do that. You know, there's systems like COBOL systems in there in government entities since 1959. And then the 20th century architectures where all of these legacy systems were departmentally organized. And then there was maverick buying over decades of different administrations. We can come in there and consolidate all of these spends onto the ServiceNow platform and replace hundreds of systems. And who wouldn't want to do that?
You do that with, you say, an elite team. You started the conversation with that. I'm interested in a change in the team. A top sales leader, Paul Smith, moving on. Is there anything to be worried about there?
Not at all. I mean, you know, the good news is Paul and I had an opportunity to build out the go-to-market together for nearly 5 years. So we have a great relationship. And we mentored Paul Smith, who, by the way, is a veteran of the United States Army, 82nd Airborne Division. So he's got the discipline of a great leader. And he's run big brands for other companies, and he's been with us for 4.5 years. And we actually had him in the global sales job last quarter. So I think we see in the numbers what he's capable of, and I have high hopes that that will continue to grow.
I want to ask you lastly about your culture and the people, because more of them are going to be moving to Florida, right? West Palm Beach. Is that going to become your headquarters, Bill?
What we're going to do is we're a California company. We started in San Diego. We have a big development center in San Diego. We have a big development center in Santa Clara. So California's home base, but we've expanded. We're growing. So we have a big commitment in New York City at the Hudson Yards. And soon we'll have a deal done, hopefully, in West Palm Beach, where we'll be able to have sort of the West, the Northeast, and the Southeast covered with big hubs. And our dream is to have a next generation AI university in West Palm Beach, where we team up with the Cleveland Clinic, Steve Ross and his outstanding company down there in West Palm Beach, and really build coalitions with the business community. But our dream is to be the AI operating system for the enterprise. We're on the move. Only ServiceNow can go east and west and north and south in these companies. So building out AI all over the United States and all over the world is something we're quite passionate about, Caroline, and we're on our way.
Well, many loving the AI, Gen AI momentum that continues. CEO Bill Dermott of ServiceNow, thanks so much for joining us. Back to you, Katie.
Thank you.
All right, our thanks to Caroline Hyde for bringing us that conversation. ServiceNow up 15%. That is your biggest percent gainer in the S&P 500 right now, which is nearing in on session highs. This would be a 3rd straight day of gains if it holds. We'll bring you deeper into the market action next. This is Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on in stocks. Looks like we're getting some momentum back here. S&P 500 now up another 0.5% after the big rally that we saw yesterday and the day before. So 3 days of gains. The NASDAQ up over 1%. You just saw Bill McDermott and ServiceNow rising 15%. You can see that investors are buying bonds, pushing the yield down on the 10-year and the 30. NVIDIA up 1.5%. That's better than a stick in the eye. IBM is down 6.5%, but it's not hugely represented on the S&P 500. Ford is up on news that we could see even fewer tariffs on auto parts. American Airlines down and Chipotle up, but both of them talking about uncertainty. And then Whirlpool off a little bit, but maybe it's not so bad for Whirlpool, Katie.
Yeah, it was interesting. We heard from their CEO yesterday on Bloomberg Television saying that maybe tariffs actually helped them.
To your question about the tariffs, you highlighted already the most important thing is 80% of what we sell in the US is produced in the US. I know very many companies talking about reshoring, onshoring. We never left. So as such, we are, no matter how you look at it, we're structurally a net winner of a tariff.
All right, interesting comments on leveling the playing field, sort of borrowing a line from the administration there. That was Whirlpool. Now, coming up in the next hour, a lot of great conversations, including with Fed Board Governor Chris Waller. This is Bloomberg.
We are 30 minutes into the trading day and gaining some momentum. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is off. And coming up, mixed signals. Trump says China may get a new tariff rate soon, but Beijing denies the two countries are even talking. Meanwhile, uncertainty weighing on companies as earnings continue to pour in. And in just a few moments, our own Michael McKee sits down with Fed Governor Chris Waller in an exclusive conversation. But let's take a look at these markets right now, because we're looking at session highs when it comes to the S&P 500, when it comes to the NASDAQ 100. You have the likes of NVIDIA making a break for it. So too are Microsoft, up about 2%, the both of them. But in terms of the points they're adding to those indexes, pretty hefty there. And you also have the 10-year Treasury yield down a little bit, Matt Miller, currently down about 5 basis points. That bid continuing to build when it comes to long duration bonds.
Yeah, so it looks good for risk assets, investors buying stocks, and investors are, I think, in a good sign, buying U.S. bonds, right? Because they aren't rejecting U.S. Treasuries. On the other hand, we have economic data that is not fantastic. You had jobless claims rising already, but just breaking now, existing home sales falling to 4.02 million. We were expecting a little bit more at 4.13 million. So not a huge miss, but it's not great.
Yeah, I'm excited. Sets up our conversation with Bess Friedman at 10:30 a.m. pretty nicely. The housing market, it still feels pretty frozen. We haven't seen mortgage rates come down in the way that maybe they were expected and hoped to.
Yeah, month over month, the drop is 5.9%. We were looking only for 3.1%. Let's get back now to Bloomberg's Michael McKee in Washington. He's sitting down with Fed Governor Christopher Waller. Mike?
Well, thank you very much, and welcome to Bloomberg Television and Radio Worldwide. Chris Waller, thank you for taking the time to come in today.
Yeah, thanks, Mike. I appreciate having me on.
You gave a speech a short time ago in which you said tariffs are the elephant in the room. Elephant seems to have only gotten bigger. You told me you were in St. Louis yesterday for a Fed Listens event, which is supposed to be about your framework review, and all anybody wanted to talk about was tariffs?
Yeah, that's pretty much the talk of the town. It's kind of hard not to talk about the economy without having to address it.
Well, the Beige Book yesterday addressed it, used the word uncertainty 80 times in that. Companies talking about not growing, but possible layoffs, getting ready to do something to try to mitigate the effects of tariffs. Are you hearing the same things from companies that they're sort of stepping back and just sitting on the sidelines? Yeah,
and that's the general tone of every person I've talked to out in the private sector, is that they're just kind of frozen by what's going to happen with tariffs. And so CapEx, everything has just come to a stop. It doesn't mean it won't happen later when there's a little more clarity, but it has actually just stopped. If the large tariffs had stayed on or come back on, then firms are trying to figure out how they're going to absorb some of that cost. And the minute they do that, they're looking at other ways to cut costs, and labor is obviously one way they do that. So it wouldn't surprise me that you might start seeing more layoffs, a tick up in the unemployment rate going forward, if the big tariffs in particular come back on. The smaller tariff world of 10 to 12%, most of the firms I talk to, they figure out they can deal with it. They kind of often give me this kind of formula. Our suppliers will eat a third of it, we'll eat a third of it, and we'll pass a third of it on to consumers. So if you're talking about a 10 to 12% tariff, it's not a big price hit to the consumers if that's all they pass through.
But economics tells us that tariffs in general are not good. So even if we get the smaller tariffs, does that still leave business on the sidelines and growth prospects lower?
Well, it is a tax, and it's inevitable that there's a tax. But however, I've always tried to tell people that, given the fiscal situation we're in, we need to get some better control of the budget deficit, and that means some combination of taxes and spending. It's just an argument about what taxes do you want to have to raise. So nobody likes taxes. I don't like taxes. But if you're going to get any kind of get our fiscal situation under control, you're going to have some tax revenue. And there's no obvious reason why tariffs should be off the table per se.
We have some tariffs in place, even though the president goes back and forth about other tariffs, but he put some on in March. When do we start to see that in the hard data?
Well, by taking off the April 2nd tariffs, you've postponed that decision until July. So we'll see some of the 10% tariffs and the auto tariffs. Some of that will start coming through particular sectors. But it's not likely to me that by the July 1st, you're going to see really big impacts from it. You will see it, like I said, in CapEx and things like that have just been put off to the side. So you'll probably see some softening in the data, but you're probably not likely to see anything dramatic happen before we get a better decision from the administration what they're going to do with the big tariff package that they initially proposed on April 2nd.
Well, what will we see first? A big rise in inflation or a slowdown in growth, perhaps epitomized by the unemployment rate?
I think you could see both of them almost happen at the same time, just in the sense of, like I said, that firms have to make a decision right away to pass through. Now, they have a lot of firms told me they have price contracts, so they're protected for a little while until they have to renegotiate those price contracts. But they're all anticipating, particularly the bigger tariffs, they're all anticipating they're going to have to cut costs somewhere. And the easiest thing to do when firms have 65 to 70% of their costs is labor, to start shedding some labor. So you might see layoffs start to happen about the same time you start seeing prices going up. So I'm not so convinced that it's going to be one first and then the other. You can see them both happen roughly at the same time, or very close together.
I assume that we're not going to see any move from the Fed on May 7th, but when would you have enough data, you think, to be able to make a decision one way or another on whether you need to move rates?
Well, as I was saying, the president's put off any decision on the large tariff world that was proposed on April 2nd until July. So all you're going to see probably till July is whatever the existing tariffs are in place. And as I said, I don't think you're going to see enough happen in the real data in the next couple of months until you get past July. When you get to the second half of the year, I think we'll start having better ideas what's going to happen with the tariff world that the administration's considering. And by then you'll start seeing more in the form of tariff price pass-through and also stuff on the real side. But there's not like you're not going to see anything on the real side because of all the uncertainty in terms of freezing decisions, spending decisions.
Well, let's put some parameters around your thinking. On the employment mandate side, what level of unemployment would bother you?
Well, it's more the speed at which it would start going up. I mean, if it just ticked up 1/10, ticked up 1/10, ticked up 1/10, kind of like what we saw last year, it would be concerning, but it wouldn't be a big problem. But if it starts going up 2/10, 3/10 a month, then that's going to happen because you're seeing layoffs starting to take off. And the labor market's in kind of a good spot. It's not like 2022 where you could reduce vacancies. Now, if labor demand pulls back, it's going to be in terms of bodies. So you'll see employment start to drop. So I'm more concerned about the speed at which the unemployment rate starts going up. And if there's a big reaction to big tariffs, it could go up very quickly.
4.5% is, I guess, the Somm rule trigger. Would that be a trigger for you?
You know, I gave a speech last September where I kind of discounted the Somm rule as a mechanical description of the data, and what it really is capturing is shocks that hit the economy. A big tariff regime being put back on in July and being put in place for the foreseeable future, that would be that kind of a big shock. So it's not so much the Somm rule as the fact that the Somm rule is really always picking up some big shock to the economy. And the big tariff regime, as it was on April 2nd, would end up being a big shock to the economy.
Well, on the inflation mandate side, since you expect some inflation from tariffs, is it the speed with which it rises as well? Because we've seen a lot of volatility in inflation numbers recently.
Yeah, that's been the struggle for me for the last basically 18 months, is that inflation progress to our 2% goal has been this kind of seesaw. You're making progress going down, but then you get a couple of bad months and it comes back down. And it's just slower than I ever thought it would have been, say, in December of 23. But the tariffs are a one-time. I still strongly believe, just the economics tells me that the tariffs are a one-time price level effect that's going to pass through. Now, it's one-time level doesn't mean it's small or big. It's just a one-time. So I still think even if it was fairly large, you would see a one-time price level effect. The demand slowdown would offset some of that. As consumers back off, employment goes down, unemployment rises, wealth continues, financial wealth declines, you will see demand effects from that. That'll put downward pressure on inflation. So it may not be as high as people think. But the critical thing is it's going to be take some courage to stare down these tariff increases in prices with the belief that they are transitory. I'm not going to lie that we all have 2021 in our minds when we think about how we go forward. But the question is, what are the things that will cause this inflation to persist through the initial tariff increases? And I just have a hard time seeing exactly what that would be.
Well, do you think if we start to see the economy slow, that you would be more reluctant to cut rates because you expect that tariffs and the higher inflation will come down because of the demand effect?
See, I'm willing to look through whatever the tariff price effects there are, and I've said that. So for me then, I'm not going to overreact to any increase in inflation that I think is attributable to the tariffs. But if I see a significant drop in the labor market, then the employment side of the mandate I think is important, and we step in. And we would have to start, I said this last week in my speech, I would expect more rate cuts and sooner once I start seeing some serious deterioration in the labor market.
Now, some people looked at your speech last week and said, Chris Waller's on the opposite side of all this from Chair Powell. Do you think there's division on the Open Market Committee about what should be done?
Well, that's the beauty of not having groupthink. People have different views about how the economy is evolving and how policies should be done. I think that's actually a healthy thing. As far as I've heard exactly that comment that Waller's outside of consensus, away from the chair, and I've had other people tell me I didn't really hear much different from what the chair said 2 days later. So this is always a funny thing about communication. I can say something and people perceive it one way to the left, or they perceive it the other way to the right. So how people receive what I say is not always one clear vision of what it is. So I'll leave it up to people to decide whether there's a difference between the chair and I. But all I can do is say what my views are, and I've tried to be very clear what they are.
A lot of people are thinking at this point that Trump being Trump and mercurial, that the tariffs could change at any moment. Would you be reluctant to move rates not knowing that you've got any certainty about what's going to be happening?
Well, like I said, what we're going to look at is the data. I mean, that's how we always determine.
But does that leave you behind the curve?
There's always that risk. You're looking at these things like, if is inflation going to get worse, is unemployment going to get worse, and it's a balancing act to make that decision. Hopefully you're not late. And I think if we saw, that's what I said, if I saw enough movement in the unemployment rate to make me think that things were going bad, or growth prospects started tanking, or consumer spending started really going down, then I'd be ready to go. I wouldn't be sitting here waiting to determine whether the inflation is transitory or not. It's time to worry about the real side of the economy.
I can't let you go without asking about Fed independence, because it's obviously the other elephant in the room these days. Will the president backing off of his comments on firing Jay Powell make it a little bit easier for you all to do your job?
Well, I try to ignore all this stuff and just focus on the data and focus on doing my job. That's what I try to do every day. Criticism of what we do, that's the job. If you don't like being criticized, don't take the job. And the president's free to say whatever they want to policy, just like anybody else. But central bank independence, as we saw, I think, on Monday, is critical to the well-functioning of the U.S. economy. It has served us well. It allows us to do things in a non-political way. And it's something I worked on in my academic life, research-wise, for 20 years about the value of it. And I don't think there's ever been anything in the data that shows you that lack of independence is a good thing.
Well, would ad hominem attacks like we've seen on the chair make it harder for the next chair to do the job? Does the job itself get harmed?
I think it's up to like I said, it's up to the person that's in the chair. You take the job knowing you're going to be criticized from markets, from Fed watchers, from average consumers. That's part of the job. And if you don't like to be criticized, don't take the job. So it's really going to be a question of whoever the next chair is. Are they going to come in and keep the tradition of central bank independence, making policy in a non-political way? And for me, that's critical for whoever the next chair is.
Chris Waller, thank you very much for your time this morning. We'll send it back to you.
Thanks, Mike.
All right, our thanks to Michael McKee, sitting down with Fed Governor Chris Waller. A great conversation ahead of the quiet period, ahead of the Fed's quiet period, ahead of the May meeting, getting tripped up there. But really interesting headlines coming out of this interview. Fed Governor Waller saying that businesses are just kind of frozen with tariffs, but that it wouldn't surprise him to see more layoffs if there are big tariffs. In terms of their plans looking forward, he said that it's unlikely that they get a clear sense of what the effect is by July 1st. So it kind of sounds like he's happy to stay on the sidelines until the second half.
Yeah, he seemed more worried about the labor side of the picture than he did about the employment side of the issue. More worried about the labor side of the issue than he did about the inflation side of the issue, because he said he sees tariffs as a one-time effect. He's willing to look through that one-time effect. And his concern is if you start to get a jump up in unemployment of more than 1/10 at a month, if it starts to move too fast, that's his concern. So I feel like, he's relatively dovish.
Yeah, he did say, though, that they do have 2021 in their minds as they go forward.
As they use the word transitory.
Yes, which is definitely a loaded term. Let's take a look at how markets have been reacting in the meantime. You can see the S&P 500 still sitting at those session highs, up about 0.8% right now. It's big tech where all of the action, all of the upside drama is, with the NASDAQ 100 higher by about 1.4%. But all the while, that bid continues in the bond market, down 5 basis points now on the 10-year Treasury yield. But definitely earnings are the hot topic of conversation, Matt.
Adding 250 points to the S&P over the past couple of sessions. So it looks good. We've got real momentum on our side. Let's take a look at some of the earnings underpinning that. ServiceNow rallying after projecting an outlook that suggests demand for software is staying resilient. You also heard Bill McDermott on this show praising the actions of Elon Musk and Doge and suggesting that he could get a lot more business that way. Texas Instruments also higher after delivering an outlook that was better than expected. You can see the stock up 6%, even though they call out uncertainty. And IBM falling. Caroline Hyde points out that they beat very low expectations, but they failed to live up to the kind of gains that we've seen on the stock in recent sessions. So as they say, government cost cuts may hurt their business. You can see the stock down 6%.
All right, coming up, we'll discuss all the market action with Brooke May, Evans May Wealth Managing Partner. That conversation up next. This is Open Interest. All right, welcome back to Open Interest. Let's break down this market right now because the S&P 500 at session highs on pretty good breath. You have over 300 companies in the green right now. You have nearly 200 moving to the downside. But again, it's all about tech when you take a look at what is dragging the index higher. Microsoft, NVIDIA, Broadcom, ServiceNow, those are your biggest gainers on a points basis. You take a look at what isn't faring too well, it's also earnings stories here. You have Fiserv, Procter & Gamble, IBM, all moving to the downside. Those are your biggest losers. And that's what you're going to see if you take a look at sectors right now. As you would expect, you have tech right out in charge, up 2% on a sector basis. You go down the list, again, more green than red, but at the bottom, if you're looking for something to scrap with, you have real estate, utilities, and consumer staples. Again, Procter & Gamble really weighing hard on that sector, Matt. Consumer staples off by about 1%.
You also see really the defensive sectors at the bottom of that chart: healthcare, energy, financials, real estate, utilities, and consumer staples. Let's talk to Brooke May about this. She is managing partner at Evans May Wealth. Brooke, this is the third day of gains. We've added 250 points to the S&P over the last 3 sessions. And I wonder if you want to sell these rallies or do you want to buy the dip? Is this a good opportunity to get in as we see some weakness, the stock market off 1,000 points from its high?
Well, it's a much better entry point than it was 9 or 10 weeks ago. That's for sure. Even though we're seeing this relief rally, we are not in the clear. We're going to continue to see volatility until we have resolution and clarity on what tariffs are going to bring. And as we saw 2 weeks ago, there's a risk to being out of the market. The market can turn on a dime. To use the word of the day, uncertainty. There's a tremendous amount of uncertainty on what tomorrow's headlines will bring. And so right now, if you're not in the market, there's a risk that you could be left behind. But you've got to expect some volatility in the weeks and really months to come.
Yeah, with that in mind, I'm wondering how you read the back and forth on trade, because we got a lot of positive headlines from the administration, from Secretary Bessent, from Trump himself when it comes to sort of the dialogue with China. Then you have China coming out and saying, we're not talking at all. We're not even having that conversation yet. But, I mean, it does signal, you could make the case, that the Trump administration perhaps is starting to blink here. And I'm wondering if that's a durable enough signal to the upside.
It depends on what you consider good news. Being that we were proposing 145% tariffs and now that's maybe 50 to 65% tariffs on China, that's still going to be pretty burdensome on the U.S. consumer and therefore the U.S. economy. So we need tariffs. We need them to be reasonable. I wouldn't necessarily say we need tariffs, but we need tariffs to be reasonable, to be able to know what the rules of the game are, and so companies can forecast what their earnings are going to be, and ultimately then how that's going to translate through to market performance.
Chris Waller basically said that we need some kind of tax revenue, and said that's what tariffs are. I guess he's not as concerned about what he sees as a one-time cost appreciation. But you said also that you need some clarity. You want to see some certainty, some resolution. Do you expect that in July after this 90-day reprieve? Do you expect that after the negotiations that we get? Or are we going to lack clarity throughout the next 3 years?
I think the latter. We will have more information between now and July. But as we know, once tariffs are imposed, it takes 2 to 3 months to see that information actually translate through to the economy. Right now, Fed Fund futures are pricing in about an 85% probability of 3 rate cuts this year. And I don't know that we'll see it without a meaningful deterioration in the labor market. The Fed has proven to be patient and cautious. And with the uncertainty around what inflation might bring in the way of tariffs, we think that they're going to be slow to actually act.
So there's a lot of wait and see sort of modes when it comes to what's going to happen with trade policy, what's that's going to mean for the economy, and what the Fed does with all of that. Let's talk about some data that we're about to get, and that is really the heart of earnings season. We have Alphabet kicking us off after the bell today. There's been some pretty scary breath when it comes to earnings revision, when you think about downgrades relative to upgrades, and you think about the fundamentals of corporate America. Not to bring up uncertainty again, but where do we stand?
Earnings are decent right now. We are seeing companies pull guidance or reduce guidance, but over 70% of companies have beat on their earnings expectation, and we can't lose sight of that. And what's probably even a little bit more exciting is that we're seeing a broadening in the market. When you look at the non-Mag 7 names, earnings expectations are supposed to be up this year from last year. So assuming we don't see dramatic downgrades, we have seen earnings expectations come down a little, but it hasn't been enough of a shift to really show a significant amount of concern.
What do you do, Brooke, if someone comes to you right now with a pile of money that needs to be invested or dealt with in some way? How do you deal with cash?
I'm dollar cost averaging in over the next 6 months. And if we get a significant pullback, we revisit the lows that we saw a few weeks back. We could accelerate those buying opportunities. But right now, I think that there's too much risk in the system to put all that money to work on day one.
All right, that's a good place to leave it. Really appreciate your time, as always, Brooke. That is Brooke May of Evans May. Meanwhile, let's take a quick check on these markets. You had the S&P 500 cracking 1% at one point, really extending those session highs. I am really interested to see what happens with Alphabet. We were having that conversation with Mandeep Singh a little bit earlier. You could argue that there's room for error here when it comes to the earnings environment. Mandeep saying the fundamentals don't look too great, but I will say that Alphabet right now is the cheapest of the Mag 7 stocks on a valuation basis.
Right, and I don't think it hurts to have the dovishness of Chris Waller on display, right? Saying that he's willing to look through tariffs. It's a one-time cost appreciation, and he's much more worried about unemployment. If that starts to tick up, he seems to be watching it more closely than he is inflation.
At the same time, though, it sounds like he wouldn't be comfortable moving until the second half of this year, and that certainly feels a long way away. You did have Beth Hammack also out saying that maybe June is when she would be comfortable. That matters, obviously, for the real estate environment, and that's what we're going to get to next. We'll get a read on real estate next with Bess Friedman. She is CEO of Brown Harris Stevens. This is Open Interest.
WeWork co-founder Adam Neumann is starting a new company called Flow. It is raising another round of funding that has more than doubled its valuation since its last round at roughly $2.5 billion. He spoke with our very own Sonali Basak, laying out his future plans for the company in an interview for the upcoming Bloomberg Originals series, Bullish.
What is the long-term goal? Do you think that this is a company that you could take public one day?
I'm sure this is a company that we can take public one day.
Do you have a timeline? I mean, is this something that you're setting a goal to that ultimate outcome for, or are you first having another goal in terms of how much you want to build in terms of residential real estate and condos?
So something beautiful about my partners, Marc Andreessen and Ben Horowitz, and David George. All three of them attend our board meetings. Marc Andreessen is the board member, but David and Ben attend the board meetings. We get to discuss very openly about exactly topics like that. And because we are still very young, only 2.5 years old, we have optionality right now. We don't need to rush. We have really doubled down on South Florida. We've made a big investment in Saudi, and it's starting to work out extremely well. And for the next 6 months, we are focused on those two things and to keep building the technology backbone that runs all of it.
That was Adam Neumann, Flow founder and CEO, speaking with Sonali Basak. You can catch the full interview on the upcoming Bloomberg Original series, Bullish. Let's get to the real estate market now, because existing home sales falling last month by the most in 3 years, thanks to high mortgage rates and high prices. Let's get more insight into the real estate market with Bess Friedman. She is Brown Harris Stevens CEO. Brown Harris Stevens is a luxury real estate brokerage in the New York metro area and South Florida. Bess, great to see you again.
Great to see you guys. Good morning.
I'm going to start with a personal story because I just signed another 12-month lease, this time across the river in Hoboken, but basically because it feels like there's nothing to buy out there. You look at the market, it just feels totally frozen, and I wonder how many people like me there are out there right now.
I think there are a lot of people that are like you, and good for you for signing a new lease.
Thank you.
There is immense uncertainty, and that's sort of rocking the housing market. You can see it in the numbers. I see it with stories from agents where sellers are holding off listing their homes, buyers are waiting to buy. Uncertainty is not a friend of the housing market or any markets, and I think right now all this back and forth is making people feel like they're on this flight with enormous turbulence, and we don't know where we're going. And one day it's this, one day it's that, and it's just not helpful.
How much of this is mortgage rates? Because I know, especially, Katie's generation looks at these mortgage rates and cannot believe how high they are.
I mean, listen, last year, we're hovering around 7%, a little under for the 30-year. Last year was back and forth similar to this. But last year, a year ago, consumer confidence was at almost 80%. Today, it's at 50%, and it keeps going down. So forgetting about rates, people aren't feeling good about anything right now. They don't know what's going on. They don't know what's happening with tariffs. They don't know what's going on globally. So people aren't going to make the biggest investment in their life right now, unless it's discretionary. That's different. But overall, the housing market has had its challenges. It's not affordable for first-time home buyers. And rates are now almost taking the back seat. We have, inflation. We don't know what's going on. What is moving is new construction, because people can go in and buy right away. Things that need renovation are going to take longer, especially because now supplies are going to be more expensive with the tariffs.
Yeah.
So, it's like we're not getting a break. I thought 2025 was going to be where we came alive and things got better. But it seems like we're almost on pause, which is not a good thing.
Steel, aluminum, lumber, renovation certainly sounds unpalatable right now. Speaking for myself, and also speaking for myself, part of the calculus in signing a 12-month lease was that maybe things will be better in a year. Was that a dumb decision? Can you help me?
No, I think you made a really smart choice, because renting gives you the time to think about and look at the environment and make good decisions. And while you're in your new apartment or you extended your lease, you can look around. And if you see an opportunity, you can always move on it. But it gives you options, and I think people are feeling a little bit uncertain right now. And it's okay, to wait it out. And the rental market is super strong, and it's going to continue to be that way, because people don't want to commit to something in the environment where rates are higher, inflation, what's going on with these tariffs, are we in a war? People are just feeling it everywhere. And, the brand of America, this sort of place, beacon of hope, of where people really trusted America, we're starting to see that tarnish, and it's just not a great thing for us.
I'm curious how sellers are feeling because, from the buyer perspective, as you just laid out, things are pretty hairy right now and it's hard to commit. What about people who are looking to list their homes? Have we seen any pullback there?
Well, I think so. If sellers are thinking about selling, well, the best thing for them to do is get maximum exposure, which is what they want. And, right now there is this new narrative about private. Have you heard about these private portals? Some brokerages. So some brokerages are promoting these private portals where you list your home internally only in that brokerage's site. And I think that is something that sellers need to be very careful of. If you think about aggregators like Zillow, which has 1.4 billion unique visitors a year.
I live on Zillow.
Everybody does. And everybody's thirsty for that live, interactive, important info. But places like companies like Compass, who in a year maybe have 20 million visitors, you want your home not just on one firm, you want it everywhere. And I think sellers need to be very careful about this sort of marketing pitch about putting your home in a private network. You want to give it maximum exposure to get true price discovery. Don't get tricked or hoodwinked by this sort of marketing pitch to keep listings internal. That's my strong opinion. And I think it's important.
I got a couple of questions about, first, construction. I mean, getting, as Katie mentions, the lumber, the aluminum, the steel, and the labor. How much more expensive is building a new home now?
It is, I think we're somewhere like 10 to 20% more expensive to do that, the cost, give or take. And for some people, it's just not, it makes no sense. People aren't going to do it. It's going to be pencils down until people have some resolve as to where the prices are going to be.
I also wonder about the SALT cap. For 100 years, we had a block against double taxation. There was no SALT cap. But then the Republicans put it in the Tax Cuts and Jobs Act in 2017, really punishing families in New York,
That's
right? A state that gives a lot more to the federal government than it gets, as opposed to other states. Is that continuing to push people out of New York and into Florida? You're in a unique position because you have these both
places. I mean, we've seen back and forth. We saw a mass migration, people moving to Florida, but then people coming back. So I think there's always going to be people who want to go. For example, Palm Beach has been a hot spot where people have just rushed to businesses. People want to be a part of that. So many New Yorkers are now in Palm Beach. But SALT, it expires, I believe.
If they don't renew the TCJA.
That's right.
Yeah.
I think that's a factor that people are considering. But I think New York is always the talent capital of the world, and people want to be a part of it. So you're going to see people come and go. I don't know how much that really will factor into people's decision making.
All right, New York will never die. Bess,
never.
It's always great to see you.
Thanks, guys.
That is Bess Friedman. She is CEO of Brown Harris Stevens. Now, let's get a check on these markets right now. The S&P 500 continuing to climb, up 1.3%, though on pretty low volume. I will point out, volume still lower relative to that 30-day average. But Matt, if this holds, this would be a third day of gains, and you have tech leading the charge.
Yeah, I mean, the last 30 days have been incredibly volatile, so it's starting to be kind of unfair. I look at the 100-day moving average, right?
Okay.
So in that, there we're like at a level that we're used to in terms of volume. In terms of the individual movers, I just want to point that out because I've been watching the volume very closely as well.
I don't know. I feel like shortening it up in this environment makes sense, given that things have been so bananas.
There's been a heck of a lot of volume lately. I mean, remember yesterday at this time in this seat, we saw volume jump 40%.
That was fun.
Let's take a look at a couple of the stocks moving this hour. American Airlines withdrew its full year earnings outlook, so they can no longer tell you what's going to happen due to economic uncertainty that they called out in the earnings call. Chipotle also reversing earlier declines in terms of the stock, but also calling out uncertainty. The restaurant chain said quarterly sales they declined for the first time in nearly 5 years. And Procter & Gamble lowering sales guidance, citing tariffs and volatility in consumer demand. You can see those shares down more than 4%.
Yeah, an interesting look at the consumer from a few different angles there, and it doesn't look good. Meanwhile, coming up, Intel reporting results after the bell today. We'll preview all of the action next with CJ Muse of Cantor Fitzgerald. This is Open Interest. Welcome back to Open Interest. Intel results due after the bell today, and Bloomberg has learned that the chipmaker is planning on cutting more than 20% of its staff this week. Joining us now is CJ Muse. He is a semiconductor analyst over at Cantor Fitzgerald. CJ, great to have you with us. So numbers aside, this is Lip-Bu Tan's first earnings call as the CEO of Intel. Clearly, based on our reporting, he has some big plans and is starting to act on them. What are you hoping to hear from the new CEO?
Yeah, hi, Katie. Thanks for having me. I think there's a lot on the plate, but I think first and foremost, he's going to come in with a radically aggressive strategic approach. I think when he left the board of directors last August, he was frustrated with how slow the turnaround was going. And so I think first and foremost, that will be the key driver of his strategy. Beyond that, I think, number one, he needs to right size the company. There are rumors that he will let go 20% of the company. And, I think that fits with where their business lies today. They have 100,000 employees today, and that is the same as AMD and TSMC combined. And they obviously have much lower revenue run rates. So they need to right-size the ship and, feel awful for those who are let go. But it's necessary at Intel. And then I think the other key factors will be, what do they do with Product Co? What do they do with Foundry Co? And, as part of that, it's really all about getting 18A right and then trying to obtain real Foundry customers. And then lastly, I would say they need an AI strategy. And so, we can touch on all of those, but those are the key points.
I actually want to touch on talk about the valuation here. Katie and I were just looking at it. $92 billion is still a pretty massive valuation. Okay, compared to NVIDIA, it's nothing, but so are most companies. So is it worth the sum of its parts, or do you think there's more value to be had here?
Yeah, our price target is $26, and that's based on some of the parts, which reflects, 2 times sales for their product business, $25 billion for the Foundry business, which, is on the books at about $80-90 billion, and then value for the equity positions that they have in Mobileye, Altera, et cetera. And so I think the real crux here is, can Lip-Bu turn the company around fast enough such that he can generate positive free cash flow and get to my $26? Or if it's a very kind of slow progression and you start, continuing to bleed free cash flow, then suddenly the some of the parts, is probably closer to where we are today. So I think it's urgency that really delivers the upside value. And so I think that's really, one of the important tenets behind Lip-Bu's strategy.
Is that what you want to see from this company, urgency? Because I noticed that you mentioned your price target. You're also neutral on this company when you think about the ratings. What would actually bump you up to a buy?
Well, I'd say if you told me today categorically that they can get to free cash flow positive and they'll do everything right in terms of actually spinning off Foundry Co, obtaining customers, getting that business to a right-sized level such that my $25 billion number, which is a guesstimate, obviously, is accurate, you tell me that, and it's a buy, right, where it's going 21 to 26. We kept the neutral rating because we're just not sure how quickly things can turn around here. And then if you want to think about upside beyond 26, it's really all about their AI strategy, which, to date has been an utter failure. Going forward, Lip-Bu has been a tremendous investor in the private AI landscape. And if he can turn it around at Intel, then that obviously would be another great source of upside.
CJ, I got a very big question for you, but given that this is your sector, I think it's a fair one. China calling out the U.S. and its inconsistency on tariffs, saying it wants to see some respect, but also says it wants the U.S. to stay out of its Taiwan situation. And, a lot of people speculate that it's possible China invades Taiwan in the not too distant future, a year and a half, 2 years. It's imaginable. Not that I have any knowledge that would lead me to believe they're going to do it. But what happens to this sector if, and I know it's a big if, China invades Taiwan?
Wow, this is above my pay grade. But, first and foremost, we're now in World War III. It is fairly mutual destruction for both countries and the world in terms of obtaining leading edge silicon. And put it, in a simple terms, you won't be able to build an Apple iPhone for 2 or 3 years. AI will no longer be the AI that we think it is. NVIDIA will not be able to build their latest generation GPUs. So it would be a tremendous global hit to GDP. And, obviously a significant negative. And, as part of it, it's part of the reason why the CHIPS Act was initiated. It's why, despite some of the rhetoric from the Trump administration, they are still absolutely committed to TSMC. And, I would note that a month ago, TSMC hit a very important threshold or milestone in their build in Arizona. And, the CHIPS Act office wrote a check to them. So, whatever, you hear out there in the news, it is a very important driver behind the CHIPS Act and building leading edge silicon. And, today the partners, TSMC, they're the only one we can count on. Right. So I don't think, near term, the China-Taiwan, will occur. But you're, Matt, 100% right. That has been a fear in Washington, D.C., particularly the Pentagon, Department of Defense, for the last decade. And, some of the reports that I've heard are, 2027 at the earliest is when China will have a Navy capable of such an offense. But I certainly hope that is something that never happens.
Yeah, certainly a tail risk to keep in mind, though, and plan around it. CJ, great to get some time with you ahead of Intel earnings after the bell. That is CJ Muse of Cantor Fitzgerald. Now, coming up, President Trump is inviting you to dinner, but only if you're one of the top holders of his meme coin. We'll have details on that story next. This is Open Interest.